and hope you're having a great day as always. Now, today we're going to be talking about it's recession talk. Yep, recession talk. We're going to be talking about how we're going to hedge it. We're going to be talking about the obvious plays which should arise if we were to actually, if a recession would actually hit. What are my thoughts? And so basically, how do we tackle this issue, right? If we are having portfolios that are high growth, what are we supposed to do? If we are having portfolios for value plays, what are we supposed to do? Yeah, so this is a topic that I think that we should be addressing very heavily right now, and planning, because there is a possibility that a recession is coming. Yep. So before that, you guys know the drill. Smash that like button if you can. Yep, smash that hard button. And to spread the algos. So, let's get to it. First of all, the markets went crazy. Yep. Because I believe it's because of this. Yeah, recession fears are spreading. But Goldman Sachs says, don't do, I don't know, what do you say? Basically, don't worry. Okay. Well, I believe this is why recession is. I mean, the whole market is actually panicking. No, even though Putin said, things will calm down. Now, there's something I want to mention first, right? And I released a video on this. I'm not sure if you guys actually watched it, but I want to address the issue that, okay, first of all, we are hit with a fall whammy, right? We have inflation going up. We have interest rates rising because of inflation. We have commodities going up as the core reason for inflation going up, right? Again, relating to supply. We have, and then we got the war. So these four is really, strong enough to actually accelerate the interest rates going up. Now, we always ask ourselves, right? Can the country afford an interest rate going up? And the reason why they can still continue to go up is simply because the economy is getting way better. Yep, it's getting way better. So unemployment rates, Fred. So unemployment rates are actually at, one of the lowest. Yep. Now, what does that mean for the economy? What does that mean for stocks? What does that mean as a sort of driver, right? And I released this in a YouTube video. I'm not sure if you guys are watching, but I think this topic is very relevant. How are we going to do it? So let's address the problems first, right? Knowing that inflation is rising, knowing that commodity is rising, this train is not going to stop in the near term, by the way. Yep. This train is not going to stop in the near term. To hedge against inflation, first of all, we need to identify and not fight the trend. We need to ride the trend, in my opinion. Bear in mind, but again, I'm not a financial advisor, right? This is not financial advice. Please do your own due diligence, which is really, really important at these times right now. Okay. Now, if we have a $100,000 portfolio, and we're thinking about, if let's say you already piled on to the heavy growth stocks since 2020 or 2021. Now, obviously, for those that have started since 2020, you'll be like, oh, wow, nice, right? You got great gains. The stock market was on steroids, and we bought low, we sold high. You realize some gains, or you're still having huge unrealized gains right now. That's great. That's great. Yeah. But for those of you that started since 2021, you'll notice that growth stocks, fintech stocks, all that have been, dropping down dramatically. And that's where we didn't get the luxury of, buying at good prices because we started late. So I'm actually addressing some scenarios. So how do we tackle that? Knowing that you bought since, 2021 and 2021, how do we hedge our portfolios to say, shit, if now, my stocks are getting a hit and now a recession is coming, what do I do to tackle that? Now, it's very obvious and the whole market's going down. So we have to, sometimes it's okay to take an L. Okay, it's okay to sell off. It's okay to trim off trim. Okay, trim, sell off, take an L, because if let's say you have been doing your research in terms of thematic plays, in terms of trying to get, because the markets, the only reason why people are freaking out is because they don't know that there are opportunities in the market. They don't know, right? So people, they freak out, they cut loss, whatever. What I'm trying to say is okay to take an L. It's okay to take an L if you know what are the opportunities that may arise before said recession happens. So there's a few options that I'm actually laying out here. Okay. Number one, if you have $100,000 portfolio and you've invested since 2021, the first thing we need to ask ourselves is, what is your cash position, right? And what are you going to take the L and to find a W? What is the L you're going to take to find that W, right? What's that next W? So the next W, in my opinion, will be riding the trend. Again, I said this before on YouTube. Now, what is the trend? We know that interest rates are rising up. We know that inflation is going up. What are the possible trends that we can actually capitalize on in lieu of this? Now, backed up by a fundamental reason. Okay. Now, what do I mean by that? Fundamental reasons would be stocks actually being a beneficiary of the EV value chain. Now, the EV train is not going to stop. Demand is going to be more and more, and it's testament because oil and gas is high as shit. It's testament. It's a no-brainer. So what should we pile onto these EVs? That is a beneficiary on the upstream side rather than the downstream. So the upstream meaning the miners, right? The ones that are actually producing it, using the materials, right? In the top in the value chain. Downstream will be Tesla, NIO, all these guys. Rather than being in the downstream, why don't we invest in the upstream where they're beneficial both ways? They're backed up by EV, the EV hype, and they are benefiting rising, earnings from rising, commodity prices, because commodity prices is insane. Okay. Now, there are a lot of companies that are actually, going up in value because of this. We got coal companies, we got lithium, but that coal, by the way, is not EV beneficiary, right? We want a long-term sustainable backed up. So we got lithium, we got, nickel. In a way, nickel prices have been shooting up the roof unsustainably. We got silicon metal prices, right? Silicon metal beneficiaries. So what are the companies that are, market leaders, that are, using clean energy? What are the companies that are, and by the way, we are investing in a good cause, clean energy, better environment, right? Clean energy, moving away from fossil fuels, moving away from, the old renewables. Yeah, whether we like it or not, we are dependent. We can't be fully dependent with the technology that we have. We can't be fully dependent on avoid fossil fuels, renewable energy, fossil fuels. But my point is, if we have our money in investing in, all these sort of beneficiaries, we are riding off there's two solid reasons why we should ride it up, right? So that is my personal play. Right, my personal play is, I'm not trying to time the market. I don't know when there will be a recession. Okay, and I know this is about recession. If let's say recession hits, what do we do? But I actually want to put this out first. I want to put it out that with due diligence, reading up the trends, riding momentum, allocating a significant portion of our portfolio, which is what we have been saying, right? I'm the 30-70 guy. Are you the 20-80 guy? Are you 10-90? I don't know. But we need to put our money, in my opinion, to be riding off these trends, because this trend is not going to subside in the year to come, in this whole year, 2022. 2021 is the year of commodities, right? In my opinion. So what do? We ride it. Yep. So if your portfolio allows it, you have time to do due diligence, do it, right? Research on what is to be expected to go up, and don't be freaking out. Don't be, learn a new thing to be researched. I mean, commodities is new to me. I've been writing off silicon metal prices going up. I've been writing off LAC going up, right? Lithium as a trade, maybe, right? As a trade for 2 weeks, 2 months, 3 months, 6 months, as long as you've done your duty, you worked out your forward PE with like, let's say coal companies, right? Coal companies having a forward PE of 7, writing off this oil and gas. We talked about Devon. Remember, we talked about Devon, ConocoPhillips, Rex. We talked about Singapore company. We talked about all these companies, and so far, so good, right? So we are riding off the trend. That's the first thing I want to address before talking about recession. Now, so let's say we write it off, and recession comes early. By the way, recession doesn't just hit like that. Okay, recession just doesn't come like straight away. It doesn't happen. That's not how it works. How it works is we got this unemployment rate here, and obviously because of COVID, unemployment rate was off the roof, right? Highest it has ever been because of lockdowns and whatnot. But after that, gradually, it's been going down. Unemployment rate is going down. That means obviously the economy is getting in way better shape, right? Way better shape. So what I want to address is, and we talked about this before, right? We talked about sector rotation. Now, what I want to address is that, oh, not here. Okay, so sector rotation. Now, the market always identifies things earlier than normal. They look at economic trends, they look at money flow, they look at what is the sentiment overall, big money, smart money, whatever you want to call it. And the question to ask ourselves is, are we like, this is the blue line. The blue line is actually in economy, and the red line is the market, right? Such a simple image, but we have to make use, of what we know. So where are we right now in, red line, blue line? I think we're here. We're not really bear market territory yet. Well, NASDAQ is bear market territory. Okay. The S&P 500, which is the biggest indicator, that's not really bear market territory yet. But it is so obvious that we will likely go into a recession more rather than not because of all the things in play. Now, the whole world works in cycles. Unemployment rates go down. That's where the Feds are actually forced to raise interest rates. And when they raise interest rates, we have, especially shorter term interest rates, we have that risk of having an inversion yield. Yep, inversion yield. Inversion yield curve basically means that the shorter term treasury yield rates are higher than the longer term treasury yield rates. That happens during a better economy environment. That happens when the whole market is actually on a tippity top of full recovery. And when interest rates rise, obviously we know that stocks, riskier assets are actually going down because, people are shifting money to bonds and whatnot. So the question is, will interest rates go to 4%, which in my opinion would be crazy? It's possible. Now it's at 2. When it goes to 4, corporates cannot borrow enough, right? Well, there'll be lesser volume because it's so expensive to borrow. Doesn't make sense. When interest rates were practically zero, growth stocks were going up because they have money to, there's more liquidity, money can be borrowed, they can expand, blah, blah, blah. So in a higher interest rate environment, this is, they are basically, saying, don't expand more because you can't afford to pay the rates. It's heavy. This is on top of whatever that you're paying, right? So when we look at the trend of Fred, we can see unemployment rates go down, and every time it goes down, that curve up, a recession happens. Yep, that curve up, recession happens. Now, when is this going to curve? This is exactly testament of what the yield curve is showing as well. The yield curve is like that, the recession happens. This is a very, very accurate, in my opinion, indicator. Now, I know what you're thinking, right, Warren? Why are you timing the market, bro? I am making an educated guess. We don't fool ourselves to say that a recession won't happen. Number one, recessions will happen. We have been riding a bull market for 12 to 13 years. Okay? Fucking 12 to 13 years of a bull. All it takes is one bear to wipe out all our portfolios. If we bought at the tippity top, a bear market going down 50%, huge bear market, will wipe out all our portfolios. But if we sell, right? If we sell. So number one, we talked about thematic plays, possible thematic plays. What are the, inflation beneficiary stocks we can go on? What are the commodity plays we can go on? All of that. Okay. Number two, we talked about recession. Don't kid ourselves that saying that there won't be a recession. Janet Yellen says that there won't be a recession. America, they might be in Europe, but not America because, and maybe I agree, because employment rates are, unemployment rates are down, the economy is strong. I do agree, the economy is strong. But as that curve happens, and when interest rates, whether we like it or not, stock market and interest rates is very relevant, right? We always have to see what happens in the treasury yields, and we always have to see what happens in, interest rates. So when interest rates happen, and when that curve actually bends up, there's most likely a recession is going to happen. It's not a definite, but don't kid ourselves that it won't happen, because we have to prepare for in the event that it does happen. That's the bottom line. That's number two. Okay. Number three, now I'm going to close this. Number three, what are the potential sectors that we can go on to when a recession does happen? Now, these in green will mean the sectors that we should be piling on to if, let's say, we enter a bear market territory. We got energy, we got staples, we got healthcare. Why? When a recession happens, and there's a lot of indications that a recession does happen simply because of energy. Again, like I said just now, we are not highly dependent on a fucking we are highly dependent on fossil fuels right now. We're not in a world where technology, we're slowly phasing there, by the way, right? Thanks to Tesla, thanks to EVs, thanks to technology, we're slowly phasing away. But whether we like it or not, electricity comes from coal, right? We still have to use coal. These coal players have been losing money since 3 years ago, 4 years ago. And now is their time. Again, everything works in cycles. Okay? Whatever goes up, something that goes up, something must come down in order for something to go up. That's how it works, right? So that is why the first play that I mentioned would work, because we are riding off cycles, we're riding off commodity, things will go up. Something must go up when something goes down. What is going down? Growth stocks is going down. Fintech is going down. EVs fundamentally should go up, but because of market sentiment, they're going down. So what is going up? Shipping. Marine shipping is going up, right? Fund flow, money flow. If you study, I use Market Smith. Yeah. If you study fund flows, they are going up. If you see, obviously coal has been going up, right? You just check out FinViz, go to FinViz groups. You can see which sector is going up. You can look at the industry, then you can filter the companies from there. So that's the top down, right? That's top down approach. What else is going up? Well, obviously silicon metal price companies are going up, industrials are going up, basic materials are going up. Fund flow is actually shifting more towards these areas. Why? Because logically that's where it should go. Basic materials should go up. All these are going up because of inflation, right? So my point is, when things go up and things go down, we should know logically where, if let's say recession does hit, these will go up. Energy, staples, because it's defensive stocks. Healthcare, because it's, obviously because it's defensive. Okay. Now I want to be sharing, I got, a new list, recession risk, right? I'm looking at $3. Why? when the 2008 recession happened, and that was like a depression, that was like huge. It took 1.5 years. So since end of 2007, the market topped and slowly on a staircase mode. So that's how problematic recessions get, right? It goes typically top and then it goes on a staircase. It's like, oh, when it goes up, people are like, okay, there's no recession. Then when it goes down, then it goes up, then it goes down. We have to be careful of these fucking things. This cycle lasted for a year and a half. Okay, before it goes back up, we can actually see here. So let's go to 2008. So I have $3 comparing with the S&P. It's lagging. And by the way, again, we are on a huge 12, 13-year bull, right? As I said, you see when I'm scrolling on the left, the S&P 500 is just piling all the way. Now, I have $3, which is a staple stock, proven performer in recession times. And I have the S&P 500. Okay. Now, just my educated guess, I thought we would have one more leg up this year before everything goes to shit, right? I thought, but I did not predict the war. Who the hell would predict a war happening this year? And this will accelerate everything. Yeah. So we got the S&P 500, which is in orange. We got $3. And as you guys already know, 2007 was like typically top best time for the S&P 500. That was before 2019, 2020. So what happened was, okay, everyone thinks the euphoria of stocks will go up, then it topped. Then after that, it took like 4 months for their prices to bottom out, $3. And the S&P 500 is like, oh, it's okay, right? But if we have detected a recession and we bought $3 at, 40, what was the price? Okay, this is not in prices, but at this price, we would see solid gains, even though when the S&P 500 is dropping down. You see that? So this is testament. This is $3 again, is a staple. The markets were freaking out. That's why you see this huge candle, right? There's a huge sell-off. And the S&P 500 bottomed out in March 2009. Now it started, the bottoming out starts since 2007. So it's a year and a half. Yep, it's a year and a half. But $3, however, when the S&P 500 is actually down 50% from here, well, 45% from here, $3 has been gaining minus 43, 11, gaining 60 to 70%. You know how crazy that is? That is insane. That is insane. So again, $3 freaked out because the whole, I'm pretty much guessing the S&P 500 is again freaking out before the last leg up. And that's where we enjoyed that fucking 12 to 13-year bull. Yep. So that's how markets work. Every time there's a bull, every time there's a bear, the bull always triumphs. That's how the markets work. There must always be a year or two of a bear before the bull goes up. I personally think that's what's going to happen. Again, don't quote me, but the facts prove it. Okay. So that's what, I hate to be timing the market, but the facts prove. So this is a completely perfect hedge because think about it. When S&P 500 goes down, staples go up. When the whole markets go up, staples go up. So that's what we call a secular industry, secular stocks. Regardless of any, it's a necessity. Regardless of anything's happening, $3, fingers crossed, $3 will be one of them, will go up. Yep. So we got $3, Walmart. In my opinion, it's a no-brainer play. I mean, it's a staple anyway. We don't expect it to go down 50%. It's not our fucking fintech stocks, right? So if you have money, after profiting, hopefully profiting from that trend that we talked about in number one, we can pile more into defensive stocks. That's my opinion. That's how I'm going to hedge this thing. Yep, that's how I'm going to hedge this thing. Walmart has been slow, but do you want your money to be volatile? Okay, so that's number one. Number two is that in a high recession environment, we got to assess what are the companies that can actually pay dividends. In a high inflation rate environment, in a high interest rate environment, the dumbest thing we can do is to be holding cash. Dumbest. We should be fully invested. I'm not talking about investing in stocks per se. We can invest in bonds. We can invest in, which to me, bonds doesn't make sense as well. But anyway, we should be thinking smart as to where the money should go. I can visualize. Money flow now, right now, is like this. Basic materials up, industrials up, whatever the heck it is, up, and then we got down, 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 down. This is your financials. This is your technology. This is your whatever. And, we got money flow, right? This is how it works. This is the money flow. Something goes up, something goes down. Now, that is in this environment. In a high recession environment, this is what I think is going to be. Up, 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 down, down, down. And again, this is and the cycle will change. This will be your basic materials already, right? It was going up, now it's going down. It's a cycle. This will be your industrials. This will be your technology. And by the way, in a recession environment, financials will go down the worst. So this may be financials as well. What is going up? Staples, utilities, healthcare. That's all. These are necessities, right? So that's what I'm predicting that's going to happen. Maybe next year, maybe next 2 years. I don't know. We should be preparing because we have everything against us right now. Don't be fucking piling onto your growth stocks if your portfolio management doesn't allow it. But bear in mind, we don't know whether it's going to happen, right? We can't time the market. So we can, if your cash positions are strong, if your cash inflow is strong, you have no risk. I mean, you're still young, or even if you're old, you have a stable job, you can plan shit out that your money can actually go into the market well. Okay, go batshit crazy. Average down in your growth stocks. There's no wrong. What I'm trying to say right now is if you're heavy on, so far, if you're heavy on a particular growth stock that is losing money, unprofitable, there's no, path to profitability is like 3 years down the road, then it might not be a wise decision to be piling on more to get more exposed. Because if you're more exposed, you can't balance shit out if something happens. You know what I mean? If something really happens and everything goes down, you can't balance it out and we'll be in a position of weakness. Does that make sense? Right? Hopefully that makes sense. So this is how I'm playing things out. Okay. When it comes to investing, it's all about looking into the future. It's all about looking in the future, right? It's all about projecting. It's all about looking in the future. It's all about educated guesses, educated risks, right? Risk management. It'll be crazy for us to be piling on the growth stocks, in my opinion, because we have all the headwinds coming in. Inflation is at its crazy levels right now. They increased by 0.8%, which is 7.9. When is it going to be in double digits? Why not ride the trend? Ride the trend. Whatever goes up, something must go down. Try to be going up with, reading where money flow. Try to be, researching on what to be hedging on, right? How do we hedge on, right? We'll be lying to ourselves if we think that, growth stocks is going to be going up all the way, right? So that's what I'm trying to say. And this is what we said at the beginning of the year. We talked about when interest rates go up, we talked about the flow, remember? When interest rates go up, what is likely to go down? Value stocks are going to go down. Growth stocks are going to go down. We were in that environment where we were enjoying, the Russell growth and Russell value, they were all going up. We were enjoying this because the difference in the interest rates were actually going down. But if this actually goes up, what will happen to Russell growth and Russell value? They will go down, right? It's most likely, it's already paved. The way is already paved. Powell has already been saying this, right? So I'm not trying to spread FUD. This is not FUD. This is if something happens, what do we do about it? Right? This is if, let's say, recession happens, what we're going to do. This is if, let's say, growth stocks do not climb up back up because there's no reason for them to, then your portfolio management should be really tight, right? And obviously another way is we can actually have a substantial amount buying this TLT ETF, Treasury, 20-year Treasury bond ETF. We could do that. It's possible. I don't like to do that. I hate investing in. I hate bonds. Bonds is shit. The maximum you can get is 2%, 3%, or maybe 4%. But well, we're losing the inflation overall. If let's say inflation hits to a core of 7, it doesn't make sense. We're burning our money. So might as well invest in stocks, right? And again, build our due diligence to be doing so. So is anyone here, by the way? Yeah, again, guys, let me know if you, again, drop that, smash that like button, smash that heart button if you enjoyed this video. Appreciate if you guys can actually, be active. We can actually, that's what these lives are for. This is what I'm personally doing. And I'll see you guys next week. Thank you.